Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to some of the key earnings for the week starting Monday, the 6th of May. And certainly as we move forward through our earnings season, we are seeing a significant drop off in terms of the amount of big ticket names reporting. Certainly comes after a fortnightly period where we saw pretty much all of the big tech stocks name, or certainly within the sort of so-called Magnificent Seven. Nonetheless, we still do have some key names to be looking out for this week. And first amongst those comes on Tuesday when we see Walt Disney announcing their latest numbers. This is for the reporting period of the second quarter of 2024 of their financial year. And certainly, if you're looking at this company, first and foremost, you can see that we're looking at a company that has a split down between entertainment and experiences that are relatively equal. We have seen question marks around both sides of the business recently, of course, where we see a drop off in the growth rate of their Disney Plus subscribers numbers. And we also see them constantly trying to ramp up the cost of their theme parks to deal with higher inflation. There's question marks about how long they can continue to do that while maintaining strong demand. In terms of where their revenues are coming from, well, by and large, they are very US focused. In terms of earnings, the quarterly numbers expected to come in at 1.10 on an EPS basis. And if you look at the annual outlook, there's this expectation that they are going to continue to grow in the years ahead to try and regain a move back towards those pre-COVID levels that we're just not back at quite yet. In terms of the expectations versus the reality, well, the past three occasions they have beat on earnings per share. In terms of revenues, the quarterly number, they have failed to hit expectations, relatively marginally so, but on the past three occasions, that is. And then if you look at, say, the annual outlook, well, they are expected to grow revenues, but not necessarily a massive clip, quite frankly. It's a gradual ascent, and maybe the focus is more on trying to get the best out of what they are actually earning when it comes to profitability. And you can see that gain that they're expecting to see on the EPS basis is much more impressive and notable when compared to what we're seeing in terms of revenues. You can see here on the weekly time frame, the recent years we've seen Disney stocks underperform in relation to the S&P 500. But if you look in terms of, say, that daily time frame, so cast your mind back around about a year, you can see it has been outperforming, certainly since those lows that we saw here in October, November kind of time. Let me just get this back onto the regular chart view. And what we can see here is that rebound really takes the shape of a sort of bottoming pattern here. And we're seeing this market head lower, much like how we're seeing the US stock market heading lower as a whole, really. It's been a bit of a tough time of late, and this stock hasn't necessarily been an exception to that. What's notable is we've come into this zone between those two major swing highs between 118 and 126 and started to head lower. So the question mark here really is, have we bottomed out? Well, we have exited this downtrend that's been dominating throughout 21 through to the sort of back end of 2023. With the breakthrough 118, it does signal the possibility that we've bottomed out here. Now, this market is heading lower, and so the question mark here is, are we going to see that continue? Are we coming into a big decline here? Or is this going to be short-term in nature before the bulls come back into play? Certainly the key swing low to be looking out for here is your 105.83, with the move back below the 76.4 fib thus far, pointed towards a possibility that 76.4 fib comes into play, which is around about your 110 mark. A move below that does call into question whether we're going to head back below that 105.83 low. Certainly, this earnings report should give us a good idea of the trajectory of this company, and the outlook will be key as much as anything. But certainly, we do have the possibility of reversing some of these really dramatic gains that we've been seeing since the lows of sort of the fourth quarter of 2023. So there is some inherent risk, in particular if we break below your 110 and your 105 kind of area. But we are seeing some tentative signs that this might have bottomed out. So near-term declines could be bought up by those expecting us to have bottomed out here for this company. So near-term, look out for 110, 105. Those are the key levels that we need to stay above for the bulls to come back into play. But certainly as things have been playing at the moment, it seems like this stock is relatively under pressure, as we see the declines seen elsewhere within the markets really feeding into a stock that has been outperforming against the S&P 500 over the course of the past year. Then looking at Uber, now we can see that Uber is an interesting stock because when we're looking at earnings per share, we haven't got much to write home about. But if you look at the annual numbers, this is where it gets interesting because we're seeing this shift out of significant yearly losses. And the expectation is, and you can see it in 2023, it's a move into and through those profitability ranks. And certainly it's notable that last year, we saw a move into profitability. The expectation is that we build on that gradually over the coming years. The quarterly figure shows you that big bumper figure for the fourth quarter. Well, we're not expecting to see the same, but maybe those low expectations of 0.22 are there to be beaten. Who knows? But certainly you can see over the past 5 quarters, we've seen massive outperformance on this earnings per share. So perhaps this is a low bar once again that has been set and sets it up to potentially outperform once again. In terms of revenues, we can see here on the annualized basis, or annual, not annualized, we can see there is expectation for pretty healthy growth as we move through the forthcoming years. And so it's a case of maintaining that trajectory. This doesn't necessarily look like a particularly cyclical stock. It's not one like, say, Apple, where they have really big Q4s because they've got the iPhone has come out, then Q1 is relatively weak. And, we don't necessarily see that. It's a case of continuously trying to grow their revenues. And the expectation is that we'll see it once again with that push finally through the $10 billion threshold. So in terms of expectations, things have been a little bit more choppy in terms of beating expectations on the revenues front. But certainly it seems to be moving in the right direction, and that move back into profitability or move into profitability last year is something that people can start really feeling a little bit more optimistic about as we move forward. In terms of the chart, we can see the pullback in line with the wider S&P 500, and you can see that, if I zoom in, it's going to give you greater clarity on exactly that relationship. We're tracking that trend basically. That does point towards a possibility of a rebound coming into play. Now, you can see it has been outperforming the S&P by and large. As we sort of zoom forward, you can see this really significant rally since those October lows. Well, this pullback's taken us into the 61.8. We're rebounding. And so the question mark is, how long does this pullback last before the bulls come back into play? Potentially Wednesday, when we see the earnings, might be that moment. In terms of the near-term trajectory, well, look out for these intraday charts because they have been relatively consistent of late. And so you're just really looking for this trend of lower highs to be maintained to signal continued downside. Now, the first port of call here is going to be let's just get rid of S&P 500 and move it back into regular pricing. The first figure you're going to be looking out for is 68.59, but above that, really the key level of 70.29. If we break up through that swing high, it points towards this market having potentially bottomed out. But until then, this bearish near-term trajectory does still hold, and certainly we still have also got the 76.4 Fibonacci level down below, if in case we do see a continuation of this pullback. But certainly that theme in terms of the move into profitability and the push onwards from there, that's going to be really key for this company. And so the pullback that we're seeing of late that really lines up with what we're seeing elsewhere in the market could be deemed a buying opportunity for investors that potentially thought this trade had run away from them. Certainly the pullback has come into a key area in terms of the 61.8. But like I said, I'd really want to see a break up through the 70.29 to signal to me anyway that perhaps that sell-off is over. Until we see that break, then there's a possibility that we see this roll over once again to continue the near-term trajectory. But from a wider perspective, does look likely that soon enough, at some point, we're going to see the bulls coming back into play, and these Fibonacci levels look particularly interesting to me. And then finally, ARM Holdings. Now, we saw this really coming into the limelight as everyone suddenly realized how much they're going to be able to benefit from this massive AI boom and the boom in semiconductors and investment in that space. But certainly when we're looking at the ARM Holdings sort of annual outlook, we can see that expectation. And bearing in mind, this is the fourth quarter of 2023, so that's why we haven't got the final number for this year. We will see this when it's reported on Wednesday. the expectation is that we do see very strong, healthy growth over the years to come, and possibly it could be even better. It depends on how things play out, really, in terms of the semiconductor space. But there's been question marks of late, as we saw SMCI sort of underperform a little bit in terms of expectations, and then we're seeing really significant declines in the space, and so we've seen this stock coming off alongside it. But ultimately, we're looking at a company that we are expecting to see them grow in terms of their revenues. I would personally expect, and we can see here, we've seen outperformance on both revenues and let's see, here we go, we're not on quarterly revenues and earnings. We're outperforming heavily on earnings, outperforming also on revenues, and that isn't necessarily as common, because if you look at the events of this first quarter earnings season thus far, generally it's earnings that they managed to beat on and less so revenues. Well, this company managed to do it on both. Question mark is, how lofty are those expectations for the markets in terms of their growth and the multiples attached to this company? Well, a lot of the heat's been taken out of it, because if you look at that rally that we saw back on the sort of 7th to 8th of February, that sharp rally drove us into this 160 mark. Prior to that, we're at sort of mid 70s. So we saw this massive rally. We've seen it consolidate since then, and essentially it's just been sort of trading within this sort of triangle formation. Let's see why that sort of dropped down. So we had this symmetrical triangle formation, and now we've seen this collapse as sentiment around the tech sector in particular has dropped off. Now, if you've watched my intro to earnings season as a whole, I did bring up a chart that highlighted the expectation that the rate of growth for tech is going to come off, as we see the rate of growth for earnings elsewhere within the market pick up over the course of this year. So there is an expectation that incessant growth is going to slow at some point in the coming year and a bit. And so that could hinder sentiment. But nonetheless, we've seen valuations come down to such a degree. I mean, if you look at the peak that we're at here in February to where we are now, we're down 40% from that level. So this ascending trend line looks particularly interesting. It's sort of in the 90s kind of area. So near term could see some downside. But I wouldn't be surprised to see people trying to pick this up now that we're back below that 100 mark. We're rolling over as things stand, but those losses aren't necessarily being held onto. So really interesting area for this stock. I think people are somewhat overreacting in the tech space at the moment, but also people are feeling a little bit concerned about what's happening in terms of monetary policy, how that might impact sentiment for the tech sector as a whole. But nonetheless, this is a really interesting one. We're rolling over once again as things stand, and ordinarily, if I see a sharp decline followed by this kind of rally, where you can see we barely gained much ground, and then we saw this stock really just breaking down once again with a breakdown through your near-term swing low, which is here. We haven't actually broken through it, but 95.55. Sorry, let's go full screen. That points towards the possibility of this rolling over and moving into another sharp decline. But I would say, that wider trend line, alongside the fact that I do think this company is going to do very well from AI. I don't think it's going away. I think that AI and the investments in it, you look at the commentary coming from all these big tech names, they're going to continue to spend, because they know that this is an absolutely massive race, and who dominates that space will be able to make them huge windfalls down the line. So I don't think that we're suddenly going to see all of their revenues drop off in a meaningful manner. I think we're potentially just getting going on this front. And so this decline could be seen as an opportunity for bulls in this market. But of course, we're seeing some potential signs of a breakdown here, but I don't necessarily think we're going to see another one like this. I think, if we do see a decline, look out for this area of trendline support. And really, I'd be surprised to see us sort of breaking back below your 85.61s, because then you're essentially looking at a closure of that gap. And I know what they say about gaps, they tend to close. But that would be a really significant decline for us to entirely reverse that gap higher and the rally and close back down to 77.71. So some question marks around this one, and certainly there have been some lofty expectations. But bear in mind, if you're coming into an earnings report off the back of really significant declines, you're better set up when it comes to potentially underperforming against expectations and the reaction versus one that's come into it already at a sort of lofty levels and people feeling very positive about that stock. This stock has already come off in a very meaningful manner, and so you'd have to see more sort of worrying signs than perhaps some of their sort of predecessors when it comes to earnings season have seen, if we're going to see continued downside, because of course we've already seen that sort of contagion within that sector driving this stock towards the downside. So a really key market to be following this week ahead, and certainly it looks like another busy one, despite the fact that we don't necessarily have the sheer amount that we've seen over the past fortnight. There's still plenty of good names to be looking into. And for sort of short-term traders or long-term investors, there's plenty to really sink our teeth into when it comes to earnings season. And these three companies in particular look really interesting for me, with their earnings taking place over Tuesday, which is Walt Disney, and Wednesday for the other two. So certainly the sort of middle part to the beginning of the week looks like the most interesting part from my perspective.